Okay, so in this lecture, I'm going to bring you a quick overview of some chart patterns which I think work best in crypto. Okay, and before I get started, I want to say I know there are many more patterns than this out there at the moment, and there's seemingly a new pattern, popping up every week. There's the Bart Simpson pattern. There's all sorts of things nowadays, but these are just a few of the patterns which I think are most important for you to be watching out for as trend continuation patterns. Let me make that clear, okay? These patterns are for identifying moments to rejoin on taking advantage of an already formed trend, okay? I personally do not believe patterns are good for identifying trend reversals, okay? And the easier way to identify a trend reversal is actually through the smart money concepts, which I'm going to be getting to in the next section after this. And looking at liquidity and liquidity sweeps is a much easier way of identifying trend reversals than trying to identify a pattern which might indicate that. There are trend reversal patterns out there that people like to look for, such as double or triple tops, or head and shoulder or inverse head and shoulder patterns. But after my personal experience trying all of these, and I have really tried play every pattern by now, I really don't think they are very effective, and it's definitely not effective for finding valid trades out of them, or at least very infrequently from my experience. Okay, so starting from the left, what we have is the bull pennant, which often gets mixed up with the symmetrical triangle. To me, they're essentially the same thing, okay? Very small difference between them, and I'm not going to bother putting them both. But essentially what it means is prices coiling together towards an apex like this with equal buying and equal selling pressure, forming an apex where you will often see a strong breakout to the upside or to the downside if you're examining a bear pennant like this. So if the trend's already up, you get a pennant like this, you are more likely than not going to see continuations from the upside out of here when you do reach an apex. And of course, many traders want to get involved at the apex, and you can get some, kind of harsh trading conditions, some very volatile trading conditions at all of these apexes, to be fair. Okay, so that's your pennant, bear pennant down here as well. Not my favorite out of these, but definitely one to watch out for. This one I definitely prefer much more, a bullish descending wedge. They usually result in they're usually quicker than a bull pennant. These take longer to play out just because they tend to be more spaced out, okay? The bullish descending wedge happens very quickly, normally provides a very explosive, move out of the pattern, okay? And, the best way to identify these patterns is just to practice, okay? There's nothing else which is going to really replace that. You'll start to see them forming over time, and you'll start to recognize which of them are valid and helpful and which of them aren't. And of course, on the opposite side to this, vice versa, we have the bearish ascending wedge. So there's a descending wedge. So generally with these patterns, okay, when price is moving up in an uptrend, you want to see the pattern pull back, okay? You want to see a retracement come in, potentially to come hit some Fibonacci levels that we've previously talked about. And then you'll often see, if you do get a kind of pullback pattern like this, you'll see eventually that there will be a break and a trend continuation, and vice versa for the bearish patterns, okay? So price moves down, coils back up into an ascending wedge, and then explodes out for continuation of the trend. So this one here, the bull flag and the bear flag, is another fantastic one. I really like working with channels personally, okay? And what you're looking for here is a upwards move or a downwards move followed by a clear, parallel channel like this, okay? And what you often get out of these is a less of an explosive move to the upside, which can actually offer easier entries on the retest. Okay, so price might come back down to test the top of the channel, okay, and can give you, an easier retest entry, which does happen occasionally. But because you don't have an apex, and what I mean by the apex is, the pinnacle of the move where price is really coiling tightly, ready to explode. Because you don't get that, you get less of a violent explosion, but you do still get a trend continuation nonetheless, and I think it's a very effective pattern. And then another example of a pattern which you can, get a retest out of just because of the nature of the resistance level is the ascending triangle or the descending triangle, okay? And price essentially coils up where you have a clear resistance which is flat, and you have buyers pushing price ever closer towards an apex, which usually results in a breakout. And the optimal entry here is you want to grab an entry for a long when price comes to retest the previous support. Okay, we're looking at this in very, very simplistic terms. Obviously, catching these entries in real time is a whole different thing, and you want to, generally be pulling in more theories of technical analysis rather than just looking purely at patterns. Okay, to wrap up this lecture, what I want to take a very quick look at is candlestick patterns. Okay, so candlestick patterns can be helpful, but in my personal belief, they are very overrated, especially on lower time frames in the crypto market. That's to do with the liquidity in the markets. With illiquid markets, analyzing individual candle patterns isn't always super effective. Okay, and I think maybe they are more effective in equities or forex, but lower time frame candlestick patterns, not really that much to go by. I would say in the higher time frame they are something to watch out for. But there are a bunch of different patterns which I think people kind of get lost in trying to find something which isn't there. So I'm going to show you a couple of patterns which I think are actually worthwhile to look for and can actually give you an indication of what's going on in the market. So what we have here is what is known as a bullish engulfing candle. And what this means is after a move down, the next bullish candle completely engulfs the body of the previous bearish candle. Okay, so this could come up to here and still be considered to be a bullish engulfing candle, and this gives a pretty good indication that strength is coming into the market. The last move down has been completely wiped out and moved to the upside, and it's definitely a good indication on higher time frames that you could be seeing a quick, sharp change in momentum and possible structural changes and reverses in the trend. Okay, next what I want to bring your attention to is this pattern, what we have right here, and this candlestick is what's known as a bullish hammer. Okay, and what we see is a very long wick with a small body at the top, and what this indicates, and again very helpful on the higher time frames, is in that given trading session the downside was completely rejected and bought up, showing you have strong demand in that trading session, and can often be points of reversal and a good indication that strength is coming in. And of course, for both these patterns, you have the opposite side, which would be the bearish engulfing candle, which after a green candle up, you'd get a red candle, which comes down and completely engulfs the previous bullish candle. That would be a bearish engulfing candle, and likewise you'd get the opposite of this, so you'd have a wick above and a red candle. Okay, and this would indicate to you that sellers came into control during this trading session and pushed price down. So coming to the actual chart, I just want to quickly show you guys why it's not always as binary as it may seem, especially with these candlestick patterns. As we can see here, you see this weekly candle right here. We have a bearish candle. We ended it red, but it's, you could say this is actually quite bullish because we can see we got a hammer. Even though the candle didn't close in the green, we still got a clear sign that in this weekly session, the downside here was rejected, and we can see exactly what happened after this. What we have here is another candle pattern right there. So you see that candle, that first red candle after this green move. We can see that's what's known as a doji candle, where you have a very, very small body of the candle, that often can look like this. Okay, so you have a very, very small body where it's barely even visible on the chart, and you have large wicks, and this is showing that there's indecision in the market. Okay, so another relatively decent pattern to watch out for, but again, nothing to really take to the bank, and nothing that I think is as useful as some of the other stuff I'll be covering in this course. And finally, really quick, just to wrap it up, I'm going to show you guys the swing high and the swing low. So a swing high is essentially where you get 3 candles in a row where the largest wick is in the middle and you have 2 smaller wicks to the left and the right. This can indicate a possible rollover and a reversal. So this is what's known as a swing high pattern. So this is the high for this given price action. And conversely, you'll be able to find the same multiple times on the downside. But again, isn't as effective as some other things. I'm not generally a huge fan of candlestick patterns, but in the extremities, they are definitely something to keep an eye on. Like for the example, this candle here, definitely worthwhile to keep on the radar.